over 2.5 million billion VND in real estate loans. That's the staggering debt now choking banks, developers, and aspiring homeowners across Vietnam. This isn't just some abstract number. It's a ticking time bomb threatening an entire nation's financial stability. Why right now? Because in just one quarter, these loans surged an unbelievable 12.71%, while average mortgage rates are skyrocketing to an insane 15 to 16%. Imagine trying to buy a home or fund a project with those numbers. This isn't just a market blip. It's a systemic shockwave about to hit countless wallets, forcing trade-offs and revealing a hidden truth about global capital. Now, for context, Vietnam's real estate market leans heavily on bank credit. We're talking about the absolute lifeblood of countless businesses and individual dreams. The official report from the Ministry of Construction, citing the state bank, confirms this. By late June 2026, real estate business loans hit over 2.5 million billion VND. This capital is crucial for everything from massive urban developments to individual home purchases, with a noticeable focus on projects with clear legal standing and strong implementation capabilities. But what happens when this essential fuel becomes prohibitively expensive? That's the core issue here. The money is flowing, yes, but it's becoming poisoned by the rising cost of borrowing. It's a classic squeeze play, impacting everyone from the biggest developers to the smallest aspiring homeowners. The hard data reveals a brutal truth. In just the second quarter, real estate business loans spiked by an unbelievable 12.71%, adding 284,073 billion VND in debt compared to late March. Think about that growth rate. It's explosive. Yet, the real shocker is the interest rate environment. Market research reports confirm loan rates are commonly hitting 12 to 14% annually. And after those initial preferential periods, many loans are flipping to floating rates of 13 to 15%, with some banks charging a mind-boggling 15 to 16%. This isn't sustainable for developers who rely on massive leverage, nor for average folks trying to buy a house. High capital costs directly translate to reduced purchasing power, causing a surge in failed transactions and a liquidity crunch across the entire market. This isn't just a slowdown, it's a systemic risk bubbling to the surface. Here's what nobody mentions about these economic shifts. They're not just numbers on a spreadsheet. Those crushing 15 to 16% interest rates are actively wiping out the financial dreams of an entire generation, making homeownership a distant fantasy. This isn't some isolated incident. It's a blueprint for what happens when capital becomes scarce and expensive globally. So what does this mean for your money and your business? It means a massive, underserved market is emerging. When traditional big-ticket items like homes become unaffordable, people desperately seek alternative ways to save money, generate income, or invest smarter. This creates a huge opportunity for savvy entrepreneurs. Your actionable step today: dig deep into high-yield savings accounts, or explore creating digital products, like budget planners on Shopify, or a step-by-step guide to building an online service business on Gumroad. Target consumers hit hardest by these economic changes. That's where the smart money is moving, and that's how you profit from this chaos. Don't just watch the news. Build a solution. Leading analysts and economists are sounding the alarm bells, calling this real estate credit surge a ticking time bomb. They're not just worried about the banks. They're projecting a ripple effect across the entire economy. Industry insiders at Bloomberg have highlighted how this unsustainable growth is forcing a reevaluation of Vietnam's near-term economic stability. What's truly shocking is the consensus. Without decisive action, this credit expansion could stifle broader investment and consumer spending, making it harder for everyday businesses to secure funding. They're urging policymakers to prioritize market transparency and sustainable capital flows, not just quantity. This isn't just about big banks, it's about the financial backbone of an entire nation. This isn't a problem confined to one country. Global markets are already feeling the tremors. International investors, particularly those in emerging markets, are becoming increasingly cautious about where they deploy capital in Southeast Asia. We're seeing a shift. Funds that once poured into speculative real estate are now seeking safer havens or projects with rock-solid legal frameworks. This means less foreign direct investment for many developing economies, impacting everything from infrastructure to tech startups. Global financial institutions are reevaluating their exposure, tightening lending standards, and demanding more rigorous due diligence for any new ventures in the region. It's a stark reminder of how interconnected our financial world truly is. Think back to the Asian financial crisis of 97-98, specifically the property bubble aspects in countries like Thailand. That's the closest parallel many economists are drawing right now. Back then, rampant speculative lending fueled an unsustainable boom, leading to a brutal bust that crippled economies for years. The key takeaway? When credit expands too rapidly into one sector without underlying economic fundamentals to support it, the fallout is inevitable. What's different this time is the scale of interconnected digital finance and global capital, potentially amplifying the shockwaves. We saw similar patterns in Japan's lost decades and even localized real estate downturns in the US, where easy credit fueled a frenzy. The lessons are clear. Uncontrolled debt has a chillingly predictable end. So, who's making bank and who's getting crushed? Clearly, the banks holding these massive, potentially distressed real estate loans are on the losing side, facing increased risk. Developers with shaky project legalities or over-leveraged positions, they're toast. But here's the unexpected twist. The winners are those specializing in distressed asset management and legal tech solutions for property verification. Think about it. When the market corrects, there will be a flood of properties needing to be unwound or reevaluated. Firms like Kroll or smaller, niche legal tech startups that can quickly vet property titles and compliance are seeing massive demand. Also, businesses offering affordable, flexible housing alternatives or even co-living spaces stand to profit as traditional homeownership becomes further out of reach. There's always an opportunity in disruption.